I couldn't have picked a better time to give this lecture than today. We're in the middle of a fiscal crisis in the Eurozone. There's no real clear indication of how it's going to end. So this is interesting material for you for practical purposes as well. I hope you've taken some ideas with you. Today we're going to do some new stuff that is related to your courses in macroeconomics that you've had before, Makro, especially Makro 2. We'll talk about fiscal policy and the interactions of fiscal policy with monetary policy and a monetary union. And it should be clear to you that the euro area is an experiment. It's a grand experiment that we really don't understand completely yet. It has immense political dimensions that we don't understand, and we have to respect the question of sovereign people coming together, different types of sovereign people, sovereign nations coming together in a momentous experiment like this has implications for democratic rights, whether a decision in one country can bind another to do something. And is the limit of my democratic rights the end of my own nose, or can I actually influence other people in one way or the other? These are very open questions and obviously beyond the realm of economic analysis. They really extend into political analysis. Today we're going to talk about a lot of interesting ideas, and I hope I finish in time. I'll review last week's lecture briefly. I'll talk about why fiscal policy has important monetary implications and why fiscal policy is relevant in regions for the monetary union's viability. Europe is not the first country or region that's had problems with this type of issue. That goes back to the United States in the 1830s and 40s, to Brazil and Argentina in the 1990s, and obviously Europe is just another example of how these things can get out of control, and we should need to understand them before we actually go off and say that the euro should be dismembered. That would be incorrect. We'll talk about fiscal policy in a sustainable sense, meaning when can fiscal policy of a region actually have a sustainable dimension and yet still be allowed in the monetary union? This means that regions can borrow money as borrowers that are sovereign in some sense, and we're still talking about a union of sovereign countries, not a United States of Europe. I'll talk about the technicalities of debt and the debt dynamics. This is a fair exam question. Trying to apply this in a reasonable way to the situation in Greece or Portugal or Ireland would be an easy question to ace if you understand the principles I'm going to give you today. And then I'm going to look at the Maastricht criteria, and I'll talk about the Stability and Growth Pact briefly as ways of implementing some of the requirements of a monetary union. Even if it's not exactly the best way of doing it, we can discuss it and criticize it. But it should be clear to you that the Maastricht criteria is an effort to prevent the kind of disaster we could have if each region did what it wanted at the cost of the rest of the union. So, I mean, I can't suppress my desire to feed in some political discussion of the past few days. Yesterday, Frau Merkel met with François Hollande from France, very high-level meeting to discuss only this issue, basically, and they gave a press conference. And it was interesting to see both leaders standing there in front of the press saying, we need solidarity, but we also need responsibility. And it's really hard to achieve that balance when you have a bunch of sovereign people who have their own histories to refer to and their own feelings about the way previous liabilities, financial liabilities, have accumulated. So this is an open question, and I really won't be able to give you an answer. This is a question you'll have to decide on your own, but you need to know the facts first. So let me just remind you what the exam will look like. We'll have some questions like this. You'll have basically the option of saying that a statement is true, false, or uncertain, and you have to explain it. Explaining gets us out of the stricture of the recent, it's not even recent, court rulings that have ruled that multiple choice are invalid game. Okay, so those people who are viewing this around the world may find this kind of amusing, but that's the way Germany is. The courts get to rule on what the universities are allowed to do. In any case, we're going to do this. This allows you to express your own ability and show your own knowledge, so it's not really a random test of your intelligence or whether you studied or not. You'll also be asked to fill in the box, fill concrete answers that may or may not involve some numerical exercises or numerical questions or quantitative questions, and then there'll be some longer essays, and you have a chance to opt out of one if you like. Okay, so you'll be able to choose. All right. Last time we talked about the necessary conditions for monetary union. There are a bunch of different conditions. They can be met with different degrees, and maybe they can be substitutes for each other. But we have this notion that what you need for a monetary union is a whole bunch of pre-requirements, most importantly the Mundell criteria, but also others that might make it more interesting to have a monetary union or less likely to have a sustainable monetary union. And we focused on the exchange rate mechanism as the adjustment within the monetary union as a way of buffering shocks, and a lot of this adjustment has to occur through non-traded goods prices, which don't move very quickly. We know that from empirical evidence from studies by the European Central Bank. You know, how frequently do hairdressers change their prices or taxi drivers change their prices compared to the price of a head of lettuce or a tomato in the marketplace? And those are very different. And then I tried to give you some of the most recent evidence on whether Europe is an optimal currency area or not. This is an open question. I also argued that this is an endogenous feature of monetary unions. There's no yes or no answer that's valid for all time. The appropriateness of Germany being a monetary union is clearly questionable given Eastern Germany, but even before, when Bismarck was unifying Germany the first time, it was not clear that Bavaria and Saxony should have the same currency as Brandenburg and North Rhine-Westphalia. But over time, this has turned out to be okay and actually a good idea. So these things can be endogenized. This is a nice picture that you should take a look at. This is sort of like those of you who like to program computers, this is kind of a nice flow chart for the issues that are relevant and how they should sort of condition your view on whether Europe should be a monetary union or not, or even whether Brazil should be a monetary union or not, or the United States. Okay, so one of the interesting facts is at the bottom we see that if you don't meet all those requirements like the European Union didn't as a whole, or even the monetary union that we observe today as a fraction of those countries, 19 out of the 28, you can still patch it up using transfers, or you can hope that people have common values, common attitudes towards monetary policy, or a sense of solidarity. So Berlin has been in deficit for many, many years, and the Germans still bail it out. It's kind of a fact, right? Bremen went bankrupt practically in 1980, Saarland in 1980, and the Germans have bailed those guys out for decades. Now, that's fine, politically okay. People grumble. People from Bavaria, Baden-Württemberg grumble about it, but they still pay. Now, the issue for us today, of course, is whether Greece or Ireland has the same level of proximity that German taxpayers or French or Finnish taxpayers or Dutch taxpayers would be willing to fork out every year money to help those guys. And, if you think about what the definition of a country is, what the definition of solidarity is, it's clearly not a yes or no answer. Okay, so it depends on maybe factors that require a fair amount of introspection. This is a really useful table, a figure to look at and stare at because it has all the criteria, but it doesn't have the names that are associated with them, so it'll help you study. So why is fiscal policy relevant? Well, if it hasn't struck you yet, it's clear that monetary policy is no longer available for the fiscal members. So by joining the European Monetary Union, each country, including Germany, gave up control over its own monetary policy. That's a fact. There's no dodging around that. It's true also for the states of Brazil or the United States or for the provinces of Argentina. Okay? And yet the regions want to have policy. They want to do something. They want to stimulate the economy when things are bad, or maybe they want to move towards a more laissez-faire cut their taxes, cut spending, and the other guys don't do that. There are all sorts of interactions, external effects from one state to another, from one government, one region, one country to another. Especially with respect to fiscal policy is the only thing you can do if you lose the monetary option. There's not much less you can do. There are a few other things you can try, but most importantly, tax and expenditure policy is the method of choice, especially if you have a recession. And also, we see in the case of Greece and Portugal and Spain, the short-run effects of negative fiscal policy have been significant. And we know why. Because in a fixed exchange rate regime or a common currency regime, there is no buffer coming from the nominal exchange rate. Okay? So, how do you finance fiscal policy in these situations? Clearly, you can't use seniorage because you don't have a central bank. You can try to press the central bank at the center to help you, but in principle, you have to use debt issue. So you run a deficit, you've got to issue bonds, and someone's got to buy them. And when you're starting the story out, when Berlin became a unified Bundesland in 1990, they had pretty much no debt, and it was no problem issuing debt. Everybody wanted to buy Berlin obligations, no problem. It's part of a well-optimized portfolio. In the meantime, the debt to GDP ratio in Berlin is probably around 80% coming from zilch. So this is an interesting exercise to show you what can happen very quickly in the matter of 20 years if a country doesn't have the discipline. So the problem is who holds that debt? The central bank can be prevailed upon to help out. But in a European monetary union, we have 19 different members. It's kind of difficult to imagine that the central bank is going to be there to help you out. And that's why the Maastricht Treaty actually prohibits that. Deficit financing by the central bank is not supposed to happen. That may happen through the back door if the central bank buys the bonds of the countries on the open market. So you can connect the dots, but in fact, it's not an explicit finance of the deficit. It's an indirect finance. But it's still prohibited. And the Supreme Court, the German Constitutional Court ruled that it was, and they passed on the decision to the European Court to see what happens. But the central banks are profitable institutions. They have a monopoly on money creation, and they hold a huge portfolio of assets, and those assets generate income. So the obvious question is, who gets that cash? And the Treaty of Maastricht provides for a key, a capital key, just like a regular bank. If you own stock in a bank, you get something from the bank, you get the dividends, you get maybe an occasional warrant or something. That's the way it works with the European Central Bank. The member governments get a piece of the action. So it's kind of obvious that it's, in some sense, the central bank is financing all the member states, although, some would like to have more or less, mostly more. Okay, so these profits can be redistributed. Usually they're just remitted. Okay, so, interest rates are low now, but a few years ago they were higher, and the European Central Bank was earning a lot on their portfolio, and they just gave it back to the member government. That's the way it works in the United States. The Fed has huge profits from their their portfolio, and these have to be remitted to the government. The government counts on that as a way of financing its deficit. Even though the Fed is technically owned by the member banks, it's actually not a money maker for these guys. They pay themselves nice salaries, but in fact, the profits go back to the government. The central bank also has other functions we've discussed. It's a lender of last resort. It's expected to bail out the banking system if they do bad things. So people complain about what happened in 2010 and 2009 in Europe. If you think about it, they did exactly the right thing. This is what a central bank is supposed to do. Unfortunately, the Treaty of Maastricht didn't really put that in the treaty. So next week we'll talk about governance issues. They made a huge mistake. Maybe they didn't want to talk about it because it's kind of political, because it means that the ECB has to run your banks. So hello France, hello Germany, you can have all your Caisse d'Épargne, and you can have your Sparkassen, but in a sense, these have systemic implications for monetary policy, for government, for the management of monetary policy that local governments cannot necessarily handle because they have external effects. Think about what happened in Spain with the real estate boom. So the central bank may have to do this, but that's also a fiscal act. Bailing out a bank is a fiscal act. Creating money to put a bank back on its feet, like the ones that are struggling in Greece right now, is a fiscal act. So in a sense, that is also a violation of the principle of Maastricht. So these are things that have to be sorted out. Okay? And here's the last one. Many of you have read about the so-called Target 2 system, imbalances. This is another sort of bleeding wound that people didn't think about when they signed the Maastricht Treaty. But anytime you have a fixed exchange rate regime, anytime you have, think of the Bretton Woods arrangement, a country running a balance of payments deficit, necessarily, just by double entry bookkeeping, has to be running a surplus on the official account, which means that the central bank of the country with the deficit, with the balance of payments deficit, is getting credit from the central banks of the other countries around the world. Okay, so in the European Monetary Union, when a country X runs not just current account, but balance of payments deficits, remember, current account plus capital account equals balance of payments. And in a system of flexible exchange rates and private capital flows, those have to be equal to zero. Those sum up to zero. But anytime you have an official account where the central banks are also dealing in exchange and holding liabilities of other central banks, you have a possibility of credit creation or borrowing between central banks. So a country like Spain had balance of payments deficit. I mean, the current account was negative and the capital account was negative. People were taking the money out of Spain and putting it in Germany and other countries. This meant that the official account had to be in surplus for Spain, or that the Germans were lending money through the central bank, through their central bank. But wait a second, Germany doesn't have a central bank. Of course it does, but it's operating through the ECB. Okay, so the accumulation of Spanish liabilities of the Central Bank of Spain on the Bundesbank's balance sheet is an accounting exercise, but it's still there. It means that, in fact, Germany sold more assets and more goods to Spain than Spain sold to Germany. Okay, that's called the Target 2 imbalance. That's a necessary condition for a monetary union. The question is, why do these lines have to be drawn along national lines? Because we'll come back to this next week. We talk about governance of a central bank and how these regional imbalances should be taking care of themselves instead of being solved politically. Because if Greece does leave the European Monetary Union, it's going to be very expensive for that reason. Because in the meantime, they've accumulated a lot of liabilities against not just Germany, but all the other central banks of the European Monetary Union. Okay, this is why fiscal policy is key. You got to get your hand on this because we don't want to be Argentina. Argentina had to give up their currency board in 2001 because some provinces ran huge deficits and thought, oh, we can get away with this because no one's looking. And if every province does that, the whole country is running a deficit. Therefore, the country is running up big, big balance of payments problems. And they had a fixed exchange rate regime with the dollar. So these are the history keeps repeating itself. The danger of having a fixed exchange rate regime is that you can get into these types of imbalances that don't correct themselves. So to understand this in a deep, formal, mathematical sense, we need to look at the math. Okay, so I'm going to write down a few equations. First, I'm going to tell you, if you think about it, the stock of debt is it obeys a differential equation. The stock of the debt is important because you have to pay interest on it. Okay, and the stock of the debt also changes, not just because you have interest, but also because your country may be running a deficit. So the stock of debt can grow for two reasons. One is that you're paying interest on the existing debt, and the other is that you're running a deficit. So if you want that thing to stop growing, you got to do a lot of heavy lifting. If you want the stock of debt to stop growing, you have to stop running a deficit. But fortunately, countries grow, so the tax base is growing, and therefore you don't focus on the debt stock. Nobody wants to pay back the national debt. The politicians who talk about this are not thinking very clearly, because Germany is much larger than it was a few decades ago, and therefore can support a larger stock of debt. There's no reason to pay off the national debt, per se, unless you think the Germans are dying out and there's no one left in 50 years to do anything. So if Germany continues to grow, for all the reasons we know, then the tax base will be higher and you can service a larger stock of debt. So there's no reason, a priori, to run a surplus. What you need to worry about is the stabilization of the stock of debt in relation to GDP. That's the most important thing you should remember from this course. And this is not ideology, this is a fact. Okay? No country has ever repaid their national debt, and Germany sure like hell didn't after World War II. Okay, for those of you who know your history, in 1953, Germany got a nice deal in the debt conference of 1953. And we're still waiting for Germany to do some, gesture, because when Germany reunified, they're supposed to actually go back to the table and negotiate this. So we're still waiting, right? Same is true of Russia, by the way. Same is true of the United States South after the Civil War. Okay, so, I'm not trying to be rhetorical, this is just a fact. So the fact is, countries stabilize debt to GDP ratios, not stocks of debt. You personally, as a household, yes, you got to pay back your mortgage. Someday you're going to pay your apartment that you bought in Berlin, but not the country as a whole. The logic doesn't work like that. So let's talk about that. Let's derive the fundamental equation for the evolution of the debt stock for a country or a region that has the ability to borrow, not necessarily only from its own people, but from others abroad. Okay? And we're going to do this case for when seigniorage is completely unavailable. So we're going to restrict our attention to the case where the region cannot avail itself of any seigniorage gain, no monetary profits at all. That's a good starting position. Okay? So let's use some symbols that you remember from Makro 2. B is the real stock of government debt. Now, why do I use that? Because what really matters is the real thing, right? If you go to Zimbabwe and you ask what's the stock of the national debt in Zimbabwean dollars, it's a very large number, but no one takes it seriously because the Zimbabwean dollar is worthless. Okay, so we're going to take B as the stock of debt. Think of it as the nominal stock of debt divided by some durable, reliable price index. And I'm going to call that P. So the price level, it could also be the CPI, but we're going to care about the GDP deflator because that's the price of what we produce, if you think about it, the price of our value added. Okay? And that thing is going to be increasing at a rate of pi. That's going to be the inflation rate, just for your information. And we're going to use the symbol Y for real GDP as we have in the past, and we're going to assume that we're going to look at long-term trends, so we're going to look at G as the rate of growth of that thing. So G positive is kind of an important thing. One of the things I'm going to talk about at the end of this lecture next week is that countries that don't grow are in trouble. So one reason Greece is in trouble is it's not growing. Italy's in trouble because it's not growing. Germany's growing. Let's hope that it keeps that up, because growth is one way to solve this debt problem, unless you think we need to reach nirvana now and just stop growing and all have a smile on our face and get our bedingungsloses Grundeinkommen, but someone's got to pay for that. And there are other countries out there that don't look at the world like that. Okay? And one is Poland, for example. One is China, certainly the United States and the UK. All right, so let's continue. PY is the nominal nominal flow of GDP, the nominal GDP measure. And PB would be the nominal stock of debt. So if you take the ratio of those two, the P cancels. I'm just doing that to make it really clear. That's why we want to stabilize the stock of debt to GDP. And it doesn't matter whether you use nominal or real, you get the same answer. Okay? And of course, that's because nominal interest rates reflect inflation. People don't lend money to the government unless they expect a real return or they calculate using a real return. And that we're going to call R, which is I minus pi. This is really basic stuff. Okay? I'm going to define the primary deficit as the deficit of a government or region when you strip off the payments of interest on the existing debt. Okay? And because this is measured in real terms, I'm going to look at the real interest payments. So since the euro area has very little inflation right now, this is a great way of starting. If you get into an inflationary environment, all these things go through. So inflation is going to kind of disappear from our equation. We're going to be looking at the real interest rate, and that's all right. But the whole thing goes through looking at a nominal interest rate. Just you have to carry around some extra baggage. So this is the real primary deficit. Government purchases, less net taxes, and net taxes are gross taxes, like everything you pay in taxes, taking off all the stuff you get back from the government. Some of you are getting BAföG, some of you are getting, maybe some other government transfer. That's not a purchase of goods by the government. It is expenditure, but it's a transfer. So that's how we get that primary deficit. Okay? So now we can start thinking about the evolution of these important objects that we care about. One is the nominal debt. That's the change in PB. And that's simply the change in the two bits. Okay, so the nominal GDP is changing because the nominal debt stock is changing because the inflation rate is positive. So you can see that the nominal debt stock is rising because of inflation anyway. When inflation is low, we can ignore that part. What's important is this deficit. And the deficit is both primary and the interest service payments. That's going to matter for our logic. So when we, the government's running a deficit, you got to change that. If you want to stabilize it, the stock. But of course, I told you already, we care about nominal GDP relative, nominal debt relative to nominal GDP. So it gets a little bit more interesting if we look at the ratio of those two. And that's what I care about. Okay, and if you look at that thing, it looks a little bit different because you can see that if the nominal GDP is growing, it's going to cut into this ratio. And if you look at history, the way countries have gotten out of these big debt traps has been economic growth or inflation. Okay, or you can also have a default. That's another way of doing it. We'll talk about all these things later. But this should make it clear that it's a race between the numerator and the denominator. The denominator is growth. So growth is important. A lot of people who want to talk about growth in a negative sense, remember if a country's indebted because in the past it's built some bridges, it's going to have to somehow service that debt. You can default on it, but if everybody does that, you'll never get to borrow money again. So there's an issue in which growth is actually an essential factor for getting this problem off the ground. So we can stabilize this object, okay, when we get the denominator and the numerator to grow at the same rate. Okay, so that's going to help me derive my equation. When the numerator and the denominator of these guys are growing at the same rate. So I've done this in nominal terms so you really see that the inflation cancels out. Interest rates, real interest rates will reflect an inflation rate, as will the deflation of debt, because nominal GDP is rising every year by the inflation rate plus the real growth rate. So these guys will cancel out. And what remains is effectively this equation. So on the left-hand side, the debt-GDP ratio is stabilized when the right-hand side, which is the growth-adjusted interest rate, is equal to the primary surplus of the government's budget. Surplus. So focusing on the debt-GDP ratio doesn't get you off the hook. You still have to run a surplus as long as the interest rate is greater than the growth rate. And over history, that's been the case. That's Piketty's point, by the way. Okay? So as long as the interest rate is higher than the growth rate, governments will have to run a surplus to stabilize their debt-to-GDP ratio. Now that is an incredibly interesting result, and that helps you understand what was going on 2 weeks ago in Brussels. I can show that to you in a second. Because the Greeks didn't want to take the heavy hit of running a big surplus, even though the sovereign lenders, the European Union, Monetary Union members, the ECB and the IMF, were willing to give them zero interest rate. Okay? So this is a great, interesting, way of looking at what happened in Brussels. So this is the result that you saw in the textbook, in my textbook also, but in any textbook. Basically, if you want to stabilize the debt-to-GDP ratio anywhere in the world, you got to get a primary surplus that's big enough to cover the interest payments you have to pay on the outstanding debt, taking into account that you've got growth. So if G is positive, that makes it a little bit less burdensome than it would be otherwise. So you see that if growth is zero, the burden you're going to have to pay, the level of the surplus is going to be even higher. Okay, so this is what guides the negotiations in Brussels right now. These guys are discussing several things. The Greeks want to get rid of B over Y. They want to get rid of B. That's called debt relief. The European lenders are offering low R, but most importantly is no one's talking about G, because no one knows what's going to happen to Greece. Greece has already lost 25% of its GDP in the past 6 years. So hopefully G is going to be positive in the next few years. Okay? There seems to be a question. Yeah. I don't think so. Because I put a minus sign in front of G minus T, which gives you T minus G. G minus T times minus 1 is T minus G. The minus of a deficit is a surplus. Okay?
I mean only by the equations. From the third line, there was the G was positive. In the next line, it was something negative without somewhere where I saw minus sign. Because minus G.
Thank you. All right, so the key result is this one. Please study this and remember it. This is important. Okay? This is like it should be etched into your hard wiring. Positive debt, positive interest rates, you got to run a surplus. The growth rate could be very high, but in the past 10, 20 years, we haven't seen that. So in the 1970s, we saw a time when European growth rates were so high that G was bigger than R. After you take inflation off the nominal interest rate, you had negative interest rates in Europe, not just in Germany, but everywhere in Europe. It was a crazy time. And that's why the debt exploded, because no one felt the pain. Because no matter what they did, the debt to GDP ratio was falling. But that ain't the way it is now. It's just the opposite. And that's why you have to really pay attention to these things. We have low G for whatever reasons. Part of that is the so-called secular stagnation hypothesis. I'm not quite a big fan of that, but it's possible. It's also because Europe has a chronic growth problem. And not just because of the monetary union. I'll show you later it's because Europe has not effectively caught the wind of the next technological revolution. If you look at the GDP underlying growth rate, TFP growth in Europe, it's been very weak compared to the United States and to other leading countries in this area. So let's figure this out. It has nothing to do with this. But it impinges on this. Okay? So interest rates are important. Long-run growth is important. If you've got a lot of debt, you've got to worry about growth. Japan, hello. United States, hello. Right? Greece, hello. Unless you get the rest of the countries to just let them go. So let's push it a little bit harder. We can look at the change. Now we looked at just the steady state before. We looked at the stabilization before. Now we're going to look at the change, i.e. from year to year. Okay, this is also possible to look at. So the change in the ratio that I care about is a race, again, between two things. It's a race between the deficit, the headline deficit, and the growth rate of the real economy. Okay, so I can resort that a little bit. So you get these three pieces. So now we can understand what happened in Brussels 2 weeks ago. It's all about this. The Greeks want to come down from their debt. And their debt GDP ratio is about 180% right now. It's enormous. It's not as high as Japan's, but Japan is not part of a monetary union. Japan can print their own money and they can do all sorts of other stuff. They have their own monetary policy. So how do you get from 180% to something more reasonable like Greece had in 1999, which was about 100% or 90%? Okay, it still may be high for your taste, but it's better than it was. But it was 90% in Greece in the late 1990s. No question about it. It's a fact. Some people have made other claims, but it's not true. Greece has deteriorated since the financial crisis by about as much as the other countries. But it's just at such a high level. So how do you get down? Well, look at this equation carefully. You can see exactly what you can do. You can play with all those components. You can ask for a big current account primary government surplus. You can ask for T minus G positive. Every year that will knock down B divided by y by a little bit. Okay? So every year that Greece has a surplus of 3% on the government account and remits that stuff to the European lenders, then it reduces B over Y by 3 percentage points. That's pretty good. Now, if Greece grows, that's even better, because then the denominator is growing. The tax base of Greece is growing. Presumably, people pay taxes. Now, of course, if R is positive, then Greece has to fight the fact that it's got this massive burden of debt and a positive interest rate. So 180% times 0.01 is still a lot of money. It's 1.8% of GDP. Okay? And then you're fighting that every period. So it explains why the negotiations were so interesting, because they were all talking about different things. The European lenders want T minus G positive. They asked for 3%. It's quite a bit. The Greeks have done a lot of heavy lifting. I don't think you could move Germany from where it is now to a 3% surplus in 3 years. People would complain. All of us would have cuts. BAföG, my salary, police, military spending. It would be disastrous. Okay? The Greeks have done some heavy lifting. There's no question about it. Okay? The Greeks want, the lenders also offered lower interest rates. So as I understand it, the negotiation, one offer on the table was 40 to 60 years of no interest on the current outstanding debt. So it's like setting R to 0. Now, if you ask me, that's pretty damn generous. It is generous. Okay, but again, it's negotiations. But no one talked about the last term in this expression, which is getting G up. So later on, I'll talk about that. Even if Greece has a very large debt to GDP ratio, if they can get back to an old growth rate that they had in the 1960s or in the late 1990s that's sustainable, then it increases their tax base and they can do all sorts of other things. They can actually make everyone better off, because you don't have to pay everything to the European lenders. You just have to pay the interest, or you have to reduce the principal. And here we're just talking about reducing the principal if R is equal to 0. Okay? Now, of course, there's the ominous possibility that all the talks in Brussels break down in the next few days, and then we have default. And that would be like saying, okay, B is now 50% of what it was before. And that means that the European taxpayers who are not Greece take a hit. Okay, so you should be clear, this is a very interesting game. It's not necessarily a zero-sum game. I think if Greece could implement policies that increase growth, it could actually make everyone better off, including us. But that's just my opinion. All right, so here's the math. If you think about it, I mean, I've just written it down to show you. If Greece could actually pull this off, I think we could get them to, if the European negotiators could get them to agree to something like was on the table 2 weeks ago, and it doesn't even have to be a 3% surplus, it could be a 1% surplus. It would mean every year they would get their debt to GDP ratio down by 5% if they grow at 4%. Of course, that growth won't come immediately. It'll take a few years. But again, I look at Poland. When Poland got their deal, which was actually debt relief, there was some growth, significant growth coming in the mid to late 1990s. Just to give you a picture of what's happened in Greece, this is a longer view since 1980. You can see when inflation came down and the Greeks eventually gave up the right to create their own money in 1999, they had to meet the Maastricht criteria. So they had to get their inflation rate down, which got their interest rates down, which actually created a surplus on the budget because their interest payments were lower. Now, unfortunately, the Greeks, like most Southern European countries, didn't take that surplus and retire the debt or restructure their economies. So they kind of missed a chance, because you can see that green line, the surplus, is always negative. They had a deficit throughout the whole period. Okay, so worth thinking about. And you can see how the debt stock evolved. So here's the debt stock, as I said, in 1999 was about 95%, 2000 it was 103%, so it's been around 100%. At the beginning of the euro era, it was already pretty high. but it wasn't 180%. The big jump happened after the financial crisis when interest rates for Greece skyrocketed. So everything they borrowed at the margin had to be serviced at a higher interest rate, and the GDP collapsed. That's how the debt-GDP ratio, the first line of this table, Staatsschulden as a percent of GDP, rose to 180%. So if I extend this to 2015, we're pushing 180% now. It's not just Greece, it's everybody. They all have this problem. But you can see that, at least at the margin, Greece wasn't like a mortal sinner until the financial crisis hit. I mean, Greece was actually, for Greeks, for Greek economic policy, things were looking pretty good, actually. Take the long perspective. Okay? All right, so it's real growth and interest rates, and debt and deficits are important. So we understand now why Maastricht had these things in the treaty in 1991, 1992. Okay, so these are important elements, and the fathers of the monetary union or the mothers of the monetary union understood this. Problem is just enforcing it. That's the problem. That's the issue. So we want to be flexible, but how much flexibility can we actually get away with without ruining the entire system? So this is an example of the small EU budget that we have. This is taken from the newspaper, Die Welt, just showing how asymmetric already the transfers are in a very small budget of the European Union. It's 1% of GDP. Okay, and this is a kind of a long-term thing. So the British are well known to be paying in. The Germans pay a lot. The French pay a lot, although people seem to think the French are getting away with murder. Not true at all. Okay, so the rich countries tend to pay in more, and the agricultural poor countries tend to take. But that's just the way it is. Okay, and the question is, do you want to expand that to include fiscal policy at a grand scale? So Maastricht we can look at in this new sort of light. It seems like a useless exercise, but in fact it was about stopping these things from getting out of control, because we've seen in Berlin, we've seen it in the other states of Germany, but also in the case of Greece, these things can quickly get out of control, and they can become a problem for everybody. Greece is a small country in the European Union, but it has financial implications. We'll talk about those next week. So ironically, if you want to guarantee national sovereignty, you want to prevent this from happening. So this is an argument for putting these mechanisms in place before the disaster happens. But disasters don't have to just be fiscal policy. You could think of a national crisis coming from a war, a national emergency, an earthquake, where seniorage is one valve that you need to use, safety valve. And we know in the United States, the U.S. dealt with the financial crisis using the central bank. The Fed basically took over AIG. The Fed bought mortgage-backed securities en masse. Okay, the balance sheet of the Fed tripled or quadrupled in size. So this is something we want to have as an option, but only as an option for the community and not for individuals. So monetary policy doesn't operate in a vacuum. Governments have an incentive to try to hit up the central bank, and this is exactly the thing we've tried to isolate and avoid. So the Maastricht criteria, are a way of preventing the central bank from becoming the intertemporal budget item for some or all of the budget of the government budgets. And I'm putting this down just to remind you what I said before. Okay. So, you can be friendly to the Maastricht criteria in the sense that each one of those criteria is related to things we've talked about in the course. We talked about inflation, for example. Well, inflation can be a problem if different countries have different inflation rates in a common currency area. It's the central bank that determines the inflation rate, but the local inflation rate is kind of linked to local fiscal policy, which may lead to overvaluation at the local level. So if Spain gets away with running a deficit for several years under the radar screen, or Greece does that, or Ireland does that, then this can cause a chronic overvaluation of the currency, which can also lead to the same kind of crisis situation that we have. It's just an example. All right, so We had these criteria last time. I made a small mistake. I don't know where that came from, but it's 2%, not 2.5%. And I think whichever student mentioned that, these all have a lot of sense. First off, we're trying to enforce convergence. We're trying to enforce long-term convergence by using financial market expectations, which show up in the long-term interest rates. Those indicate expectations of future inflation way down the road, 10-year debt. The government debt requirement is 60%. So at the outset, only a fraction of the countries met that, and we'll talk about that in a second. But at least we focused attention on this indicator. So the point of doing this is to make people pay attention to these indicators. So we're looking at surveillance now. We're looking at something that the IMF did in the 1960s, looking at other countries' budgets. People may resent it, but that's part of life. If we want to have a common currency, we got to let each other look at each other's dirty laundry, if you like. The government deficit, less than 3%. We'll talk about that in a minute because that's really different from what we talked about before. We talked about the primary deficit, not the consolidated deficit, not the headline deficit. And of course, exchange rate stability. So all these things are ways of guaranteeing some sort of stability to the system. We showed last time that inflation, pretty good record, but for some strange reason in the financial crisis, things kind of diverged a little bit. And not surprisingly, that's come back to haunt us. And you can see that that brown line is Greece. It had a bit of excess in 2009-10, but it actually paid for it dearly in the years that follow. You know, in a common currency area, you'd expect that to happen. I mean, in Mexico, you don't see the price of tortillas in one part of the country being much higher than the other for a long, long time because people will start taking advantage of that, you know, profiting from that. So it's the same thing true of a monetary union. And the overvaluation in Greece has been largely removed. The problem is the economy is on the ropes. Interest rates converge, perhaps too much, because that induced all sorts of financial misbehavior. Next week we'll talk about that. The sovereign debt crisis is exactly a product of treating all countries' debt the same and not thinking about difficulties in the political sphere. Now the interesting question is this 3%, where does that come from? Okay, is it arbitrary or does it have some sort of economic meaning? Because I told you before, to stabilize B over Y, you got to get certain things to happen. The primary surplus has to equal the risk of the growth-adjusted debt service on the existing debt. But Maastricht talks about the total deficit. So that's basically the primary deficit plus the interest payments. So why do they do that? Probably because it's politically easier to communicate, but it is related to what we've done. I'll show you right now. The primary surplus for stability is basically this. You need this condition to hold. So the primary surplus has to be equal to this right-hand side term, which is the risk of the growth-adjusted interest servicing cost for the country, which could be negative. If you get concessionary interest rates, R could be 0. Okay? Now that means that basically the headline surplus has to be equal to that. And G is positive, hopefully, and B over Y is obviously positive, so that has to be negative. So that's the stability requirement. And you can think about Maastricht as just imposing that this item has to be less than 3% of GDP. So this seems like a bit restrictive. If you think about what we did before, a country that grows really fast would still can't be a candidate for stability, but wouldn't satisfy the Maastricht criterion. So we're kind of making it hard for high-growing countries to get away with a large debt stock or a large deficit. Okay, so this is one reason why fast-growing countries should not join the euro right away. It's going to put a straitjacket on fiscal policy for these countries if they are growing fast. Okay, and the Maastricht, if you just reorganize the rule, it also implies that the debt stock is something like 3 divided by G if you're stabilized. It has to be less than that. Okay, so that's interesting. That's very interesting. But if a country is growing about 2% per year, that shows up, that gives us a number which is it's not exactly right. So we'll have to come back and check that. But anyway, it's compatible with the Maastricht 60% rule. Yeah. G should be 5%. Why? For?
Exactly that equation. If you do that, then it's compatible with 60% of debts.
Okay. Yeah, but that still doesn't work though. So I think I'm gonna have to come back to that. We'll fix it next week. Anyway, I'm trying to take these Maastricht criteria, which don't seem to be advised by any real deliberation on what the steady state growth rate is. I mean, if you take the real interest rate of being 3% and the sustainable growth rate of being 2%, that would be like a mature economy like Germany or France. It's not clear where that comes from. That's what I was trying to get at. So, if you look at the fiscal compliance numbers, I pulled this off the internet yesterday, and you can see that basically just focusing attention on this, and most countries are growing, has basically, performance is bad, but it's not that bad. And the countries at the very bottom are the ones we'd expect, but they're moving in the right direction because they're running current account primary government surpluses, or because they're in a program, or both. There are a few countries that are large that are not doing so well, but again, we know they're dealing with it, and that some of them are not members of the monetary union. Okay. So it may seem like a useless exercise, but in fact, it's a way of stopping problems before they became evident. So I've already shown this slide, but it's nice to look at it again in those terms. Now, a next effort to sort of patch up this is the Stability and Growth Pact, and I need to discuss this briefly. It became clear, even before the monetary union was instituted, that fiscal interactions would be a problem, could be a problem, and you needed to have some institutions that sort of made it clear to the countries what was expected of them. So this Stability and Growth Pact was kind of implemented just before the onset of the monetary union to regulate that. And it's based in the treaty. It's basically consists of two parts. One is kind of a preventive, informative arm, so it's like looking very carefully at budgets, having an annual review. And the second part involves penalties. And these penalties I'm not going to talk about because they've never been really enforced. But the idea was to make countries that were in violation of these, the 3% stricture, to have to pay some money, to pay depending on the severity of the violation. Now, the reason why this wasn't enforced is because usually a country that doesn't meet the requirements is in trouble. So it's kind of weird. It's almost, anti-solidarity to actually ask countries to pay a fine when they're in trouble. So people realize this is maybe not such a great idea. It's not time consistent. It's just like the Barrow-Gordon problem. Barrow-Gordon said, the central bank promises inflation, but the people know that inflation is going to be high because the central bank has always done that, and they love inflation. Same thing is true for a government. The government will promise to have a primary current account surplus, but when people aren't looking again, politics is king, and they takes over, and politicians do what they want. So you can take it one way or the other. I mean, you can take it as a sign that these countries are under a lot of duress, which they are, or you can say that there's just no enforcement mechanism that you can impose on a sovereign country. I mean, we just had a referendum in Greece where the Greeks actually said, we don't want to do this. So what can you say about that? We have sovereign countries, this union of sovereign countries. You have a set of rules. Somehow you have to balance the two. So ironically, Germany and France were the first to break, in a big way, the pact in 2003, and they both agreed, well, let's just let it go. We're in charge anyway, so what's the problem? That was Schröder and Chirac, because those countries were in a recession, and Germany was just reforming its labor markets and needed some slack didn't want to start cutting the budget in the middle of that mess. So and you can take this as a message that even Germany needs some help sometimes. Okay, so the Euro Pact Plus, as it's called, is more sort of open cooperation and exchange of information, with a goal of having some sort of relatively stabilized fiscal policy rule structure. But we don't have any sort of serious, I don't think we want to have fiscal policy rules that constrain the only mechanism that countries still have to deal with problems. You know, tax cut or a government spending increase in the case of a recession. If they have some fiscal space, if they have a low B over Y, then it makes sense. So why do you want to stop them from doing that? But by focusing attention on each other's problems, it has increased pressure to behave like good citizens. And right now we have this crisis. So the crisis is kind of taking all our attention, and just one country basically, but it's important because it's a precedent. Whatever we do in this particular case is going to extend to the entire union, and if country X gets a really good deal, then I think it's going to create a precedent for other countries to ask for the same treatment. So let's interpret the euro crisis in this light. I'd like to give three different interpretations. One is that there's a lot of excess local aggregate demand for a long time after the euro was introduced in some countries, not in all. And that led to a relative loss of competitiveness, a balance of payments, or balance of trade and current account deficit, and led to, at some point, a sudden stop reversal of capital flows. Another interpretation, other countries have other problems. We saw in the case of Ireland and Spain, those countries had very good fiscal policy, and then they had a banking crisis, and then the government had to bail out the banks and had to increase its borrowing by tens of % of GDP. In 1 year, Ireland went from 30 or 40% of GDP debt to 100%, because they had to bail out, and they committed to bail out the entire banking system without any haircut. So when you do that, it's always going to be expensive. So this is the issue of moral hazard. Watching the banks is what we're going to talk about in the last lecture of the course next week. Okay? Another interpretation is that this sudden convergence of interest rates, which was not exploited by the governments in the local end, also caused a surge of demand. So this is one interpretation of what happened in Greece. In Greece, interest rates came down so sharply. Banks, not just Greek banks, but foreign banks, including banks from this country, were there indirectly trying to encourage people to borrow money so they could buy a car, fix their house, buy a house. So that's another way demand in the southern European and also in Ireland periphery increased. So all three of these were operating in some combination for all the countries in crisis. And because the debt to GDP ratios were so high, we had this problem. So the interesting question for me right now is this discussion that we see in the newspapers. And I think we should all think about it because you're intelligent economists and you're learning about this for a reason, not just because you want to do well in the exam, you want to be able to discuss this with people critically. And to me, this is the question of austerity, which means getting the primary surplus more positive or moving from negative to positive versus getting G up. Okay? A lot of the newspaper articles and political discussion have seen this as a trade-off. So if you want to have more growth, you got to have less austerity. Okay, and it's not clear to me that that's the case. It may be the case if you're only focusing on short-term aggregate demand effects of spending. So obviously if you cut the budget, if you raise taxes in a region, you're going to cause a slowdown because of Keynesian effects that we understand. Okay? But that's one way of achieving growth. It's really more of a flash-in-the-pan approach. You'll get some growth for a few years if you stimulate the economy with government spending or a tax cut that's deficit financed, but at some point you're going to have to pay it back. It's not going to be a sustainable increase that will help you pay off debt that you've got on the books. To do that, you've got to change the conditions for the private sector to function. And, people keep pointing to the euro as the cause of the European malaise. I don't see that, because even countries like Denmark have had this issue. Okay, and other countries like Sweden have had it less so, but Sweden is also not particularly very different. They're not running huge deficits, and they're also fairly conservative economic policy at the present. They have an inflation target, and inflation has been quite low in that country as well. So to me, it seems like we need to think not just about austerity versus growth, but austerity, possibly maybe even less austerity, and more growth, pro-growth policies. And if you look at what the countries have done until now, they've really front-loaded on the austerity, possibly because they don't want to do it, and it looks good for them to be against their voters. They can say, look what they've made us do, but they haven't done the heavy lifting, which is reform the economy, maybe in the way that Schroeder did in 2003 in the labor markets in Germany, or in the Netherlands in 1983, or in other countries we can talk about. Just to give you an idea of how bad it is in these countries, these are two plots of GDP constant prices for Italy and Germany since 1980. So you can see that both are growing. Italy was always growing a little bit less rapidly than Germany over this period. If you take some sort of HP trend and look at that, up until 2007, which is before the financial crisis really hit. So the question is, was it just the financial crisis, or was something else going on? We know that Italy has suffered a huge loss of competitiveness, not because Italy was doing anything wrong, but other countries in the world economy are competing with Italian products in a way that they have not seen probably since the last century. So these are issues that a country needs to deal with. It's not clear that monetary policy is going to solve that problem. You're going to reform your markets, loosen up your labor laws. Sorry, that's just the way it is. And if you look at employment, it's showing up there too. The Italians have a real unemployment problem, and it's not something that just appeared in the past 3 or 4 years. So changing product policy might be one way of doing it. This is something that people don't talk about enough. These are things that take a long time to implement, and they take a long time to actually have effect. And Germany is no saint in this area either. I'll show you the data. So if you're interested, go to this website. It's run by the World Bank. It's not a lobby for industry or business. It's the World Bank website, doingbusiness.org, and you can look up your own country and see how it's doing. It presents a set of indicators, starting with the ease of starting a business, the ease of closing a business, security of electricity, reliability of electricity supply, ease of enforcing contracts, dealing with the administration, getting permits, how long does it take? A lot of times, heavy-duty corruption is involved. You have to bribe people, you have to wait for years to get a permit. And it's very interesting to see how the countries you suspect are actually in the right position, as you suspected. So here's the Doing Business indicator in 2013. So at the very top is Singapore, Hong Kong, New Zealand. Okay, those are the most business-friendly. Now, ironically, Denmark is number 5. Okay, so that's a European country. Norway is number 9. Finland, 12. Sweden, 14. Ireland, 15. Where's Germany? Where's France? Oh, I see. There they are. Okay, so in the Zweite Liga, Germany, number 21. Netherlands, 28. Still don't see France. There it is, 38. Okay, so France has actually deteriorated since 2010. This indicator's been around for a long time, by the way. Now, where are the other countries that interest us? Well, Portugal is 31, so Portugal's actually doing okay. It's done better. There's Italy, 65. In 2011, it was 87. So they're getting better. Obviously, there's pressure on them to change things, including the regulation of professions and the like. Spain is 52. Greece is 72. In 2011, it was 100. Okay, so you go figure, this is not an accident. It's the tendencies are positive for most of these countries. Means if you want to start a business, that's one way of employing people, one way of creating jobs. It's very hard to get a large company to advertise 10,000 positions, but if you get 5,000 small companies to hire 2 people, you can get a similar effect. Okay, so that's an important theme for next week as well, because it's called economic governance, creating the supply side that's right. It's not just about demand side. Next lecture, we'll talk about the sovereign debt crisis in detail. We'll talk about the chain of events that led to it, different interpretations. There are people who say that the sovereign debt crisis was not the fault of the countries, but the fault of the financial markets. You can take that position, but you need to defend it. You need to be able to defend it. The other position is that these countries have been on a bad path for many years, and the European Union didn't pay attention, didn't do enough to put countries back on the right track. So surveillance is a very important issue. Überwachung, right? Like the IMF used to do in the 1950s and 60s when we had fixed exchange rates. The same idea, same issues were operational. We'll talk about the unintended effects of the financial crisis. So a lot of people blame the United States for the financial crisis. You can do that, but Europe was not prepared for it. And the financial crisis hit these countries differentially, so we had a differential shock, just in the sense of Mundell, as he told us. Some countries did better, some did worse. And one of the reasons that they were differentially affected is because they had different levels of debt. So obviously countries like Greece and Greece and Portugal were less prepared than a country like Spain. But Spain had this housing boom, which made it vulnerable. And Ireland had its housing bank bust, which made it vulnerable. And we'll talk about deeper types of integration. So every time I talk about European integration now, I'm talking about political integration, developing policy arms and mechanisms that go beyond national boundaries. So every time you talk about this, people get really sensitive. The French don't want the bank regulators coming into their banks. The Germans don't want bank regulators coming into their banks in general, especially the small banks, okay, for whatever reasons. This is a political issue. Also, capital markets. It would be great if Europe could develop something like Wall Street, have a single capital market, and companies could go there and borrow money directly instead of going through national conduits. But do you want to go further? Do you want to have a fiscal union? Do you want to have a central European budget? See, it's very political now. Do you want to have a government budget at the European level? Then you're going to have to start caring about who you vote for the European Parliament, because those people are going to have serious power. I'm not sure that's what Europe signed up for when they signed up for the monetary union. So it becomes political, even though it's supposed to be just economic. All right? So regardless of how you stand on this, because it's a personal opinion, it's a normative question, it's not a positive one, but you need to have at least some form of governance and exchange of information to make the system work. Okay? So thanks for your attention. I'll see you next week.